Connie Albrecht is 54 years old, sitting in an estate attorney's office 3 weeks after her father's funeral, and the woman across the desk is explaining something Connie has never heard before. Her father spent 38 years working for a paper company in western Pennsylvania. He drove a used car until it had 200,000 miles on it. He packed his lunch. He maxed out his IRA contributions every year he could. And in the last decade of his life, he watched that account grow to just over $400,000. He was proud of it. He told Connie about it. He told her it was for her and her brother when he was gone. He named them both on the beneficiary form. He thought that was the responsible thing to do. Connie thought so too. The attorney is still talking. She is saying words like 10-year rule and required distributions and ordinary income, and Connie is nodding slowly because she does not want to look like she does not understand. But she does not understand. Not yet. What she does understand, when the attorney finally slows down and says it plainly, is this: the IRS now has a clock running on her father's IRA. That clock started the day he died, and Connie and her brother have 10 years to pull every dollar out of that account. Not at their own pace. Not when it is convenient. 10 years, and then it is gone or penalized. She drives home thinking her father left her a gift. She is starting to realize he left her a tax problem. Not because he was careless, but because neither of them knew about a law that changed everything. I'm Harrison Vale, a former estate planning attorney and retirement risk analyst. On Legacy Defense Report, I take the rules that stay buried in tax notices, estate files, and beneficiary forms, and I put them into plain English while your family still has time to do something about it. If that sounds like the kind of warning you want in your corner, subscribe now. And drop your state in the comments, because IRA withdrawals are taxed as ordinary income at the federal level, but your state's income tax rules on inherited retirement money can make this worse or slightly less painful, depending on where you live. That detail matters, and I want to know where you are. Now, go back to that office for a second. Connie's father did what most financial articles tell you to do. He saved early. He saved consistently. He named his kids as beneficiaries so the account would pass directly to them without going through probate. He avoided the courthouse. He thought he had handled it. He had handled it the way the old rules worked. What he did not know, what millions of retirement savers still do not know, is that Congress changed those rules in December of 2019, and the change hit non-spouse beneficiaries like Connie and her brother directly in the wallet. Before that law passed, an adult child who inherited a traditional IRA could stretch the withdrawals out over their own life expectancy. If Connie was 54 when she inherited and had a life expectancy of another 30 years by IRS tables, she could take small, manageable distributions over 30 years. A little each year. Taxed each year, yes, but spread out thin enough that it might not push her into a higher bracket. It might barely move the needle. That strategy had a name. People called it the stretch IRA. Estate planners built entire inheritance plans around it. Congress eliminated it for most non-spouse beneficiaries, quietly, in a bill called the Secure Act. And the replacement rule is not complicated, but the consequences of it are. The replacement rule says this: if you inherit a traditional IRA from someone who was not your spouse, and you are an adult child, you have 10 years from the date of their death to withdraw the entire account. 10 years. The full balance. Every dollar counts as ordinary income in the year you pull it out. Miss the 10-year deadline, and the IRS penalty is significant. That is the trap. Not laziness. Not bad intentions. A law that changed while your parents were still alive, while the beneficiary form still had your name on it from 15 years ago, while nobody called to say the old plan no longer works. Connie's father signed that beneficiary form when Connie was in her 30s. He never updated it. Nobody told him to. The form looked the same. The account looked the same. But the tax consequence waiting behind it had changed completely. $400,000. 2 children. 10 years. And both of them have full-time jobs, mortgages, and incomes of their own. The IRS does not care about that. The clock is already running. Let's put the stretch IRA on the table for a moment, because understanding what families lost when Congress eliminated it is the only way to feel the full weight of what replaced it. Before the Secure Act took effect in January 2020, An adult child who inherited a traditional IRA had a powerful option. The IRS allowed them to take distributions based on their own life expectancy. If you were 50 years old when you inherited, the IRS life expectancy tables gave you roughly another 34 years. You could divide the account balance by 34, take that fraction each year, and spread the tax hit across 3 decades. The withdrawals were still taxable, but they were small enough, in most cases, that they barely disturbed the rest of your financial life. A parent with $400,000 in an IRA could pass it to a 50-year-old child, and that child might take $12,000 or $13,000 a year in required distributions. That amount might not even push them into a higher bracket. The rest of the account kept growing, tax-deferred, inside the inherited IRA. The family got the benefit of decades of continued growth. The government got its tax revenue. Just slowly, Congress watched that slow drip arrangement and decided it was leaving too much money in tax-deferred accounts for too long. The official justification in the Secure Act was about retirement security. The practical effect, from a tax revenue standpoint, was that compressing the withdrawal window from a lifetime into 10 years forces larger withdrawals sooner, which means more taxable income hitting faster. That is the honest mechanism behind the rule change. The government needed the money. The 10-year window delivers it. So what does the 10-year rule actually require? Here is the plain English version. If you are an adult child and you inherit a traditional IRA from a parent who died after the 31st of December 2019, you must withdraw the entire account balance within 10 years of the date of death. There is no minimum amount you have to take each year. You could theoretically take nothing for 9 years and pull the entire balance in year 10. But the IRS clarified in proposed regulations in 2022 that if your parent had already started taking their own required minimum distributions before they died, you as the beneficiary are also required to take annual distributions during those 10 years, not just a lump sum at the end. That clarification caught many families and even some advisors off guard. The 10-year clock does not pause for a bad market. It does not pause because you lost your job. It does not care that the account dropped in value the year you needed to make a large withdrawal. The rule runs because the calendar says it runs. Now walk through the numbers with Connie and her brother. Their father's IRA was worth $400,000 at his death. Split between 2 beneficiaries, each of them inherits $200,000 in a separate inherited IRA. Connie earns $90,000 a year as a project manager. Her brother, who works in construction management, earns around $85,000. If Connie takes the $200,000 evenly across 10 years, she pulls out $20,000 per year. Add that to her $90,000 salary, and her gross income for the year becomes $110,000. In 2025 federal tax brackets for a single filer, that puts her solidly in the 22% bracket for most of that income, with a portion touching the 24% bracket depending on her deductions. That is manageable, uncomfortable, but manageable, if she plans for it. But what if Connie waits? What if she takes nothing for the first 7 years, thinking she will handle it later, and then realizes in year 8 that the account has continued growing, and she now has a larger balance to clear in 3 years? If the account grew modestly, and she now has $250,000 left, she needs to pull roughly $83,000 per year for 3 years. Stack that on top of her $90,000 salary, and her income for those years approaches $170,000. She is now in the 32% federal bracket. The government is taking nearly a third of every dollar she pulls from that account. Her father built that money at a 22% marginal rate during his working years. She is liquidating it at 32% during hers. The family lost 10 percentage points of federal tax efficiency on a significant portion of that inheritance, simply because of timing. And that is before her state takes its share. Several states, including states with large retiree populations, tax IRA withdrawals as ordinary income at the state level. Add 4, 5, or 6% on top of the federal bill, and the math gets harder to look at. There is one more layer that surprises people. Connie's increased income in those high withdrawal years can affect other things. It can affect whether she qualifies for certain deductions. It can affect her Medicare premium calculations if she is close to Medicare age. It can push capital gains that would have been taxed at 0% into the 15% bracket. A larger taxable income does not just mean a higher rate on the IRA money. It can reprice other parts of her financial picture at the same time. Her father did not intend any of this. He thought he was leaving her money. He was. He just did not know the IRS would be standing at the door with a 10-year deadline and a tax bracket she was not ready for. Write yes or no in the comments. Did you know the stretch IRA was eliminated before you watched this? The families who are in the best position right now are not necessarily the ones with the most money. They are the ones who found out about this rule while the account owner was still alive. While there was still time to look at the beneficiary form, run the numbers, and ask whether the plan still makes sense. That question, whether the plan still makes sense, is exactly what the next part of this story is about. Not every family takes the same hit from the 10-year rule. The damage depends on who inherits the account, what they earn, where they live, and how the account was structured before the original owner died. Some families walk into this trap at full speed. Others find ways to soften it, sometimes significantly, but only if they planned before the death certificate was signed. Start with who gets hit the hardest. The worst position to be in is an adult child in their peak earning years. Think 40 to 60 years old, established career, solid salary, possibly a working spouse adding income on top of that. These are the people the stretch IRA was most valuable for. They had decades of life expectancy ahead of them, which meant decades to spread the withdrawals thin. The 10-year rule eliminated that runway entirely. Now, a 50-year-old inheriting a $400,000 IRA from a parent has to clear the account before they turn 60, right in the middle of the years when their own income is likely at its highest. The situation gets more complicated when multiple adult children split one IRA. When a parent names 2 or 3 kids as co-beneficiaries, the account has to be split into separate inherited IRAs, ideally within the year of death, and each child then faces their own 10-year clock on their portion. That sounds orderly. The problem is that siblings rarely earn the same income. One child might be a teacher earning $55,000 a year. Another might be a physician earning $250,000. The same inherited balance creates a dramatically different tax consequence depending on which sibling holds it. The parent's single beneficiary designation treated both children the same. The tax code does not. High tax states make this worse. An adult child in California, New York, New Jersey, or Minnesota inheriting a traditional IRA is not just paying federal income tax on every withdrawal. They are paying state income tax on top of it. In California, the top marginal state rate sits above 13% for high earners. Stack that on a 32 or 35% federal rate, and the family is losing close to half of every dollar on the high end of the withdrawal range. That is not a hypothetical. That is arithmetic. Now here is where the blueprint changes, because not every beneficiary is subject to the 10-year rule. The law created a category called eligible designated beneficiaries, and these individuals still have access to something close to the old stretch. A surviving spouse who inherits the IRA has the most flexibility. They can roll it into their own IRA entirely and treat it as if it were always theirs, delaying required distributions until their own RMD age. A minor child of the deceased, not a grandchild, but a direct minor child, can stretch distributions over their life expectancy until they reach the age of majority, at which point the 10-year rule kicks in for the remainder. A beneficiary who is disabled or chronically ill under IRS definitions may also qualify for the stretch. And a beneficiary who is not more than 10 years younger than the person who died a sibling close in age, for example, can stretch over their own life expectancy as well. An adult child in good health, earning a salary, and more than 10 years younger than the deceased parent does not qualify. That describes the majority of people watching this. So what are families doing when they find out about this rule while there is still time? The conversation that comes up most often is the Roth conversion. A traditional IRA holds pre-tax money. Every dollar inside it has never been taxed. When the owner converts some or all of that account to a Roth IRA during their lifetime, they pay income tax on the converted amount in the year they do it. That hurts in the short term. But a Roth IRA that is inherited by an adult child is still subject to the 10-year rule. The child still has to empty it within 10 years, with one critical difference. Qualified distributions from an inherited Roth IRA are generally tax-free. The child pulls the money out, and they owe nothing to the IRS on it, as long as the Roth account was at least 5 years old when the original owner died. Think about what that means for a parent sitting on a large traditional IRA in their late 60s or early 70s. If they convert a portion of it to a Roth each year, paying tax now at their current rate, they are effectively prepaying the tax bill their children would otherwise face. If the parent is in a lower bracket than the adult child will be, which is often the case when the parent is retired and the child is still working, the family pays less tax overall. The math has to be run carefully, and a CPA needs to be involved, but this is one of the most widely discussed strategies for families dealing with this rule. The second conversation is about trust-based beneficiary designations. Some families name a specially drafted trust as the beneficiary of an IRA rather than naming the adult children directly. When structured correctly, a trust can provide more control over how and when the money is distributed, which can matter when one of the beneficiaries is a spendthrift, has creditor problems, or is going through a divorce. These are not arrangements to set up without an estate planning attorney. A poorly drafted trust, named as an IRA beneficiary, can trigger worse tax outcomes than naming the children outright. But for certain family situations, it is a conversation worth having before the account owner dies. A third approach is simply sequencing. Some parents with both Roth and traditional accounts decide to spend down their traditional IRA more aggressively during their own retirement, keeping withdrawals within manageable brackets, and leaving the Roth balance with its tax-free withdrawal benefit to the kids. The children still face the 10-year rule on the inherited Roth, but they face it without a tax bill attached to every distribution. Have you checked your IRA beneficiary forms in the last 5 years? Not your will, not your trust documents. The beneficiary form on file at the brokerage or bank that holds the account. That form controls who gets the money and under what category. If it still names your adult children, and you have not reviewed it since before 2020, you may be working off a plan that Congress already changed without telling you. Are your kids in their peak earning years right now? Drop yes or no in the comments. Because the answer to that question changes what the 10-year rule costs your family considerably. The families in the best position are not the ones who panicked after watching a video. They are the ones who brought this question to a CPA or an estate planning attorney while the account owner was still healthy, still had options, and still had time to restructure something. The danger is not that every family loses everything. The danger is that families wait until the options have already closed. And some of those options close faster than people expect. Pull back from the numbers for a moment and think about what actually happened to Connie. Her father was not negligent. He was not uninformed in the way people are when they simply never tried. He built a retirement account over decades, named his children on the beneficiary form, and believed he had handled the inheritance piece of his life responsibly. The form was on file. The account was funded. The intention was clear. What he did not have was a conversation with anyone who knew that the rules had changed. Not his bank. Not the brokerage where the IRA sat. Not a CPA. Not an estate planning attorney. Nobody called him after December 2019 and said your beneficiary plan is built on a rule that no longer exists. The account looked identical. The form looked identical. The trap was invisible. Connie found out 3 weeks after the funeral, in an attorney's office, at the worst possible moment for absorbing complicated tax information. That is the version of this story that is still avoidable for most people watching this right now. So here is the self-check. Work through these questions honestly, because the answers tell you how much urgency you are actually sitting with. First question. When did you last update the beneficiary form on your IRA or 401? Not your will. Wills do not control retirement accounts. The beneficiary form on file at the institution controls the account. If you signed that form 10 or 15 years ago, it was signed under the old rules. The stretch IRA still existed. The planning assumptions behind that form are no longer accurate. If you cannot remember when you last updated it, call the institution this week and ask them to tell you who is named and when the form was last changed. That phone call costs nothing. Second question, are the people named on your beneficiary form adult children who are currently in their peak earning years? A child in their 40s or 50s who is already earning $80, $90, or $100,000 a year from their own job is the person most exposed to the tax stacking problem. Every dollar they pull from your inherited IRA lands on top of their existing income. If you have a child who is younger, lower earning, or who has a disability that qualifies them under IRS rules, the picture may look different. But if your beneficiaries are working adults at the height of their careers, the 10-year rule hits them at the worst possible tax moment. Third question. Do you have a mix of Roth and traditional retirement accounts, or is everything sitting in pre-tax money? If you have both, the sequencing of what you spend and what you leave behind matters more than most people realize. Leaving a large traditional IRA to adult children and spending your Roth during your own lifetime is the opposite of what many families should consider. A CPA can model what the after-tax inheritance looks like under different scenarios. That modeling conversation, which costs a few hours of professional time, can be worth a substantial amount to your children's actual take-home from the inheritance. Fourth question, have you talked to your kids about this? Not about the money specifically. That conversation is personal and every family handles it differently, but about the mechanics. Do they know an inherited IRA comes with a 10-year clock? Do they know that withdrawals are taxable income in the year they take them? Do they know they should not wait until year 9 to think about the strategy? If they find out after you are gone, inside an attorney's office the way Connie did, the options for managing the tax hit are significantly narrower. The account is already inherited, the clock is already running. The only decisions left are withdrawal timing and tax year management, and those decisions get harder to optimize under grief. This is the kind of paperwork that quietly outranks everything else in your estate plan. Your will can say whatever you want. Your trust can have beautifully drafted language in it. Your intentions can be perfectly clear to every person in your family. None of that overrides the beneficiary form. None of that stops the 10-year clock. The IRS follows the form and the calendar, not the intention. The rule is the same whether the account is worth $50,000 or $1.2 million. The percentage lost to taxes can scale dramatically with the account size, but the structure of the trap is identical. A parent who saved modestly and a parent who saved aggressively both need to have this conversation. The family with the larger account has more at stake in dollar terms. The family with the smaller account may have less room to absorb a poorly timed tax hit if the child is already stretched thin. Do not move money and do not restructure anything based solely on what you heard in this video. That is not the move. The move is to bring these questions to a CPA or an estate planning attorney before the account owner's health changes, before the estate goes into motion, and before the clock starts without your permission. The danger is not that every family loses everything to taxes. The danger is that families wait until their options have already quietly disappeared, and they find that out the hard way, in an office, weeks after the funeral. Connie's father left her something real. $400,000 built over 38 years of packed lunches and used cars and maxed out contributions. That is not a small thing. What he could not leave her was a warning he never received himself. You have the warning now. The person who acts on it while the account owner is still alive, while the beneficiary form can still be reviewed, while a Roth conversion or a sequencing conversation or a trust discussion is still possible. That person protects what the decades of saving were actually for. The person who files this away and comes back to it later is Connie, sitting in that office, nodding at words she does not yet understand, watching a 10-year clock tick that started without her. Subscribe now, save this, and send it to the person in your family who handles the financial paperwork. Because the families who find this rule early are the ones who still have a choice. The ones who find it late are the ones paying for the delay.